Welcome to Finance Agents Live, episode 42. Today we're going to be talking about fix and flip financing, how to get 100% lending in order to finance your fix and flip purchases, rehabs, and acquisitions. Thanks for coming online. Remember, if it's your first time on, subscribe, like the show. We appreciate that, and it helps us help more people just like you. So jumping right into it today, Darren, if you can move forward with the slides. Next week, we're going to be talking about fraudulent funding services. This is something, I've been doing this for 10 years. I've seen all sorts of crazy stuff. You're not going to believe what I've seen. We're going to be talking about this next week. We're going to be telling you about the things to look out for, giving you some horror stories of people that have been through some weird stuff. I've seen people go to jail. All right, so it's important you don't involve yourself with fraudulent financing things. So come back next week. That's episode 43. But for now, jumping back into positive fun stuff, which is fix and flip financing to cover 100% of your costs. Let's jump right into it. All right, so first of all, let's talk about the standard fix and flip program that we have. We've been offering this since last year. It's been very popular. It is our next fastest growing program. You may remember a year and a half ago, CRE, real estate, private money program. That grew very quickly and has been a huge success. Fix and flip has been the next fastest growing program right out of the gates. We've had a lot of interest in a lot of apps. And there's a lot of reasons why. So let's go over the program benefits, what it includes. First of all, it covers the acquisition financing. That's the financing of the purchase of the property, up to 90% for the standard program. It also covers your rehabilitation costs, the money that you need to put into the property in order to improve it, because hopefully it's worth more money, otherwise why are you doing it? It can fund in as little as 14 days. Although it sometimes takes a little longer depending on the responsiveness of the client. And you're looking at loan sizes anywhere from 100 grand up to 5 million. Admittedly, we're not doing a ton of $5 million deals. We see more on the low side. And just so you know, that $100,000 is for the rehabilitation costs and the acquisition costs. So if you're looking at a low value property, but you need to put money in and that total loan will be worth over 100, that's fine. In fact, you're going to see an example in a little bit of somebody with a $91,000 loan. All right, so who qualifies for our traditional fix and flip financing program? It's actually relatively easy to qualify for compared to most other products. You need a 600 or better FICO. You do not need to have any experience, although if they have some, it might help you get better pricing. The after repair value needs to be at least 140% of the loan. So if it's a $100,000 loan between acquisition and rehab, the appraiser needs to believe that it has an after repair value of at least 140 grand. And you're going to need to show that you have assets in order to get approved in the beginning. Assets meaning you have to show you have the 10% for the purchase and the rehab, 10% of the total project cost. You need to have that in the bank, plus at least 3 months payments. So if they see that your payments are going to be $1,000 a month, you're going to need to have your 10% plus $3,000. You got to have all that in advance to qualify for the regular program. So let's jump into some sample clients. We got a few of them in here for you to look at. First of all is a property in New York. It was $488,000 was the funding amount. Now here's an interesting one. You may look at this and think, oh, he's starting to tell us how we can do 100% financing. Well, strangely, we have a few 100% financings in here, but that's not actually what I'm talking about for 100%. You want to stay till the end and we'll show you how you can take our normal fix and flip program and pair it with some other stuff in order to get 100% every time. But this is sort of a surprising example. Here is a client who already owned the property and he had enough equity in the property he was able to pull money out. So it was a cash out refinance. He was able to pull enough cash out of the property to pay all the rehabilitation costs. Now, you still have all the rules that we had. So it was 90% of the acquisition, which there is no acquisition cost. So 90% of the loan, the total loan couldn't exceed 90% of the acquisition costs and the rehab costs. The acquisition cost doesn't make sense, but the appraiser was able to see that once they pulled the money out and put it back in, the property would be worth at least 140% of the loan that they pulled out. Hope you're not confused, but it's a cash out refi, so those are available. This person had absolutely no fix and flip experience whatsoever. He was a contractor, so he does know how to do construction, but no fix and flip. So in New York, the property value is about $650, so you could see how that 140% worked. And like I said, it's 100% financing, plus the absolutely only cash you had to come out of pocket with was enough to pay for the appraisal and for pay the $495 commitment fee in order to get into the property. And what's interesting about that property is there was significant rehabilitation. Maybe you could tell just by looking at it that it needed a lot of work, and that's fine. That's a good thing, right? That means there was a lot that could be accomplished by improving the property. All right, so that's client number one. Client number two, here's another one, $520,000. This is another cash out refi. Again, we're going to show you, you may think, I don't have that much equity in my property. I don't even own it yet. That's fine. You could still get 100% financing. We'll show you later. But for here's another cash out refi. Again, somebody no fix and flip experience. The property was also $650,000. Those numbers are too similar. That might be a typo, but it was significant equity in the property, and they got 100% financing. So the first two were fairly similar. Going into client number three, this third client had $110,000 funding, and I think it was another cash out refi. We got three cash out refis in a row. This person had done one flip in the past. The property value is worth $235,000. So again, you see how there's plenty of room for a $110,000 loan, plus the rehab cost and everything. It's already worth 140% of the loan amount. Got 100% financing and just barely hit that 600 FICO minimum. So you could be right around the bottom and it can still work. And one thing that was interesting about this deal that's different from other ones is in the cash out, client had to pay off about $30,000 in tax liens, and that's okay, right? So he pulled money out, paid tax liens, did some renovation, and it's going to be worth well over that in order to qualify for this great financing. Okay, and the last example we're going to show you right now is $91,000 loan price. This was for purchase. This is more traditional fix and flip. This is the kind of stuff we're doing regularly. I don't know how the three cash outs got in there. No fix and flip experience again, so we're okay with people that are new to this. Property value is $168,000. Got 100% financing except for the appraisal and the commitment fee. I'm sorry, that's got to be wrong because this is a purchase, so there's no way they're going to do 100% financing. So I think this is probably a typo. But it's going to be 90 and 90 on the purchase and the acquisition. The loan cost is definitely $91,000. But they're just over the FICO minimum, and interesting property. Look at that deck. I think they can redo the deck. Okay, so benefits. What are the benefits of our normal fix and flip program, not including what we're going to talk about later? 100% financing is available if you add another program into it. That's what we're going to talk about. Funding ranges, like I said, $100,000 to $5 million. Standardized pricing nationwide. So if you're in a state where you think, hey, my state, I get worse pricing, don't worry. Standardized pricing, there's no penalties for being in a bad state. There's low documentation requirements, no experience requirements. A lot of people are going to like that. If you're looking to get into this, you've never done it before, no problem. There's no DTI calculations. Some of the fix and flip lenders will pull your tax returns, look at your debt and say, I don't know if I like the DTI, forget it. That's not an issue. They may look at your tax returns, but it's not to disqualify, it's just to have a full package. Fast funding can happen in as quickly as 2 weeks. That's important. If you're out there shopping for properties and something's on the market, you don't know that's going to be around for a long time. So the ability to fund quickly is important. If you're out shopping, come to us in advance. Let's get all your information on the books and ready so that when you find a property, we can strike quickly. And another interesting thing about a property is unlimited draws for the renovation. Let me explain that a little bit. When you get the acquisition funding, of course, that happens at once. But you're going to be working on this property maybe 6 months. So the lender isn't going to give you all that construction money in advance. They're going to give it to you over time. What some lenders will do, they'll restrict you. They say you can only have 3 draws or 4 or 6. But this lender has unlimited draws. I don't know if they'll go as much as weekly, but they'll do very frequent draws, and that helps you with cash flow. Another interesting part of that is they'll do partial percent draws. So if you say, we put the drywall up at 60% up, that's fine. They'll fund an incomplete aspect of the project as long as they see progress and you are willing to pay for they're going to have an inspector come out and inspect each part. So that is an extra cost to pay for the ongoing inspections. and that's maybe a penalty of doing frequent disbursements, but it's okay and it qualifies. All right, so let's talk about the current market a little bit. What has changed in fix and flip financing? How's it different from 2 years ago? And maybe how is it looking in the future? I would say right now is a very mature market. We're 10 years into a bull run, right? Things were pretty ugly 10 years ago, as you will remember. Property values were low, but they've been rising for a long time. And there's been a lot of time for the fix and flip lenders to really consolidate and have good quality programs. So financing is going to happen definitely faster than it did 2 years ago. It's easier to get financing. It's easier to get more financing. And these are all things that we're drawing on in order to be able to give these 90 and 90% options. And rates have been coming down over the years, so the rates are lower. The rates that we're seeing are ranging from 10 to 2 to 12 and 5. That's kind of the range. 10 to 2 meaning 10% interest with a 2% origination fee. That's on the low side. Up to 12% interest with a 5% origination fee. That's on the high side. And one of the things that might impact that would be your experience. But those rates have been coming down, and so it's a good time to do fix and flip lending. The economy is strong. There's a lot of buyers, low unemployment, good time to be in the market. Now, some of the changes that we see happening going in the future, one of the interesting things on the lender side is that there are mortgage-backed securities that are being created just specifically for fix and flip lending. That means a lot of lenders out there are taking their portfolios and they're selling them off to institutional investors, which means they have more money to lend. That's one of the reasons why it's easier to get a loan and the rates are coming down. We see that expanding and a lot more of that happening, which means that, and here's the other part of it, we don't see rates continuing to drop because as a country, interest rates are starting to go up. But what's going to happen is they're going to stay the same even as the rates rise, which is kind of like the rates dropping. All right, let's say you're interested in financing fix and flip with us. Let's go over the documents we need in order to give you a review. Well, there's 4 things that we're going to need, and those are the fix and flip application, we'll need your renovation budget, we'll need the purchase sale agreement for the property you want to buy, and 1 year's tax return. That could be a business or personal tax return. Right now when I'm doing this, tax season just happened. If you haven't filed last year's tax return, it doesn't matter. You can give us the previous year. It is not a problem. All right, so I have some screenshots of the application here. We're not going to spend a lot of time going through it. I just wanted you to get a look at it. It's 5 pages long. We get a cover page. We ask for information about you. We ask for information about the project. We have some legal disclosures that say you're not doing something crazy. And then it ends with the commitment fee. If we look at your deal and we like it, then there's a $495 commitment fee in order to start the process, and that is applied towards your closing costs. So it's not extra money, it's just a commitment fee so we know that you're working with us. Occasionally we have somebody pay the commitment fee and the after repair value doesn't work. An appraiser goes out, they says, hey, this is not going to hit that 140%, or what most people call it, they say 70%. The loan can't exceed 70% of the appraised after repair value. And the good news is, well, maybe that was a bad deal and maybe we help keep you out of it. You can keep shopping for your next deal, and you bring your next deal to us. You don't have to pay another $495 commitment fee. That's already paid and we'll apply it to the next one. So we're working with you. We just want to know that you're working with us. All right, so let's go with some of the common issues that affect people applying for fix and flip that make it a little more complicated. First of all, we got some location issues, and you may recognize some of these if you're in the industry. California is the first location issue, which is different from the other ones, and that's because the market is so hot out here. There's so many lenders. A lot of people are starting to feel like it's oversaturated and overly exuberant. We somewhat agree. So we can lend in California, but it's going to be a little bit slower. The rates are actually going to be a little bit higher potentially because we're going to be more careful because it's just a hot market, right? So if you're in California, I'm sorry, I'm in California, a little bit harder to do the deals here. Nevada as well, it's a little more complicated. Nevada has some weird laws that say if you're going to lend in Nevada, you actually have to be in Nevada or have a brick and mortar location there. That makes it harder. That might make the rates a little bit higher. Arizona, Florida, same things. The rates might be a little bit higher because those markets are hot or have some weird lending laws. Arizona, it's the lending law. Florida, it's another hot market. Atlanta, we could totally lend in Atlanta, but we've been hearing that that might be another micro bubble. This is one of the things we do and our lenders are doing is they're constantly watching for oversaturated, overly hot markets. And frankly, if you're there, you might want to be real careful. Say if the property values are going up and you're getting unrealistic lending expectations or the after repair values aren't hitting, maybe you want to be nervous and maybe it's time to go a little bit outside your area to find a place that's not so overly saturated. And then finally, rural areas, like if the population is under 20,000 people within an area, then it's going to be real hard for us to justify that because there's just not enough liquidity in the market. Meaning you might build it up and that thing might be worth a lot, but it might sit there for a year without you able to sell it because there's just not a lot of people there. I see somebody's asking, so you're looking for lending in Connecticut. That is not a problem. It's a good state and it's not on our watch list. So feel free to submit it in and we'll be happy to look at the opportunity. Here are some other issues that you're going to need to overcome if you want to get this financing. The first one, and the absolute most common one, is that the client overestimates the impact of the renovations. So let's say you're buying a property worth $100,000, you're going to put $50,000 into it, and you believe that now that $100,000 property is going to be worth $400,000. Well, I hope so, but the appraiser's got to agree with you. If the appraiser says it's only going to be worth $160,000 or $170,000, it's not going to fit that 70%. The loan can't exceed 70% of the after repair value. So that is the first and most common problem that we have to deal with. Second is if you've had a foreclosure within the last 2 years, that's going to be a problem. Luckily, if it was more than 2 years ago, not a problem, surprisingly. So if you say, I foreclosure 3 years ago, it's time to get back in, right? Market's good, and maybe be a little more careful this time, but it's okay. Same thing with bankruptcy. You need to be at least a couple years after your bankruptcy was terminated, completed, in order for us to consider it. But honestly, we don't have a lot of people. Man, I can't think of a single client we've had within the last couple months that's been declined for credit or for these other issues. Most people are able to clear that hurdle with no problem. Another issue is maybe you don't have a company and you're just doing it personally. It's okay, but our lender really prefers that you have a corporate entity for them to put onto the books. So if you don't have one, you might want to think about doing it. There's a lot of tax benefits. And lastly, if you have multiple partners, the foreclosure and bankruptcy and credit requirements, anybody with 10% or more ownership in the business has to hit all those requirements. So if you got a partner with bad credit or a recent foreclosure or bankruptcy that needs to own 9% or less of the business, maybe it's better to just take them off altogether and just have a rev share agreement with them and not have an ownership partnership. But that's up to you, however you want to deal with it. All right, let's zip through the funding process real quick in order to give you an idea how it works. As always, if you're a finance agent with us, all we want you to do is go out and market the program. One of the great things about marketing fix and flip financing is flippers tend to flip on a regular basis. Once they do one, they're going to do more deals. And we are a relationship lender. We want to work with somebody to do 3, 4, 5 flips a year. We have some guys that have a goal of doing 24 flips in a year. Awesome, right? If you're currently with a lender that only lends up to 80% or 70% of the purchase and rehab costs, then by coming here, you might be able to do twice as many flips. Great, that's what we want to help you do. Somebody's asking, is rural location totally impossible or there's still something that can be done? It is very difficult, but nothing is totally impossible. If it's the right situation, we want to look at it and we might be able to help you out. All right, so if you're a finance agent, we want to refer a deal to us, refer a client to us, there's 4 ways to do it. First, is just log into the platform and submit the lead. Great, you can attach docs. Second is to send out your marketing link to somebody and have them fill it out. You can find your links right on your dashboard. Third, just email it in from the email address you use to create your agent account. Send a lead to lead@24houраpprovals.com. Attach whatever documentation you have in order to make it easier for us. And lastly, you can just call up your rep, explain the scenario, and we'll jump right on it and help out your client. After that happens, everything else is going to be happening with the member office who's working with us, who's trained on the product. They'll be able to collect application, all the documentation, submit it to our lender representative, and then the lender representative is mostly going to take over from there. They're going to be working directly with the client through all the steps, which makes it real easy for you. Just get them in and we'll work through the whole thing, ordering appraisal, working through STIBs, working through extra documentation that may need to be required. As far as a typical funding timeline, I know I said it can happen in as little as 14 days, and it can, but generally we're seeing these take about 3 to 4 weeks, most of the time because it takes some time for clients to get all the paperwork together, and that is fine. We'll work at the speed that your client requires. And some people, maybe they are in no rush and they want to do it over months, whatever they want to do is fine with us, but we could do it in as little as 14 days. Once the app comes in, the app will be reviewed by an underwriter. We'll be looking at the location. We'll be running the numbers, making sure it fits the 90, 90, and 70. Again, that's 90% of acquisition. The loan will not exceed 90% of the acquisition, 90% of the rehab costs, and it cannot exceed 70% of the anticipated after repair value as determined by the appraiser. It's not your idea of the after repair value, it's what the appraiser says. And of course, we're going to look at the borrower, make sure that they fit the qualifications that we mentioned previously. After that happens, moving on, after that happens, we're going to issue an LOI. The LOI will go out to the borrower needs to sign it, pay the $495 commitment fee, and we order appraisal immediately because we don't want anything to slow it down. After the appraiser comes in, we collect all the extra documents. There's actually a decent amount of documents that need to be collected. Don't worry, we handle all that. We're going to order hazard and title insurance. We'll submit the complete application for final underwriting. That takes 1 to 2 days. If that's good, they'll order docs. That could take 1 to 3 days. And typically, the day your client signs is the day funds are dispersed. So we know usually when you get to that point, people are real anxious to be done with the process. Maybe they have a seller who is anxious to sell. Everybody's anxious, we understand, and at that point, it tends to fund immediately. All right, let's zip through some terminology real quick just to make sure we're all on the same page. Renovation budget, that needs to be pretty detailed. We need to know exactly what you want to do to the property, and then the appraiser and us, we're going to be, sort of verifying the legitimacy of the cost. So it's not too line item, but if you say you're going to put in a new bathroom and do this and that, if they say it's 20 grand and we think it would cost a lot more or a lot less, this is going to be part of the back and forth communication we're going to have. ARV is after repair value, as I mentioned, as determined by the appraiser. As is value is the value right now, before any renovation is done. If you purchased the property recently, let's say within the last year, we're going to assume the purchase price is the as-is value. Now you may say, hey, I got a great deal on the property. Awesome. It's good for you. But we need to see that the after repair value is going to be higher, and that's going to be considered the as-is value. There's a few initials you need to know. That's LTC, LTV, LTA, and EIN. All right, so let's knock through those real quick. LTC is loan to cost. So for the purchase, we're going to be, and the renovation costs, that's a loan to cost. Can't exceed 90% of those costs. And then loan to value is determined by the after repair value, can't exceed 70% of the proposed after repair value. LTA is the loan to acquisition. That's basically the loan, the cost to buy it. EIN is the employer identification number as issued by the government for your company. For some reason, a lot of people are surprised when we ask for an EIN. If you have a corporation, you of course need to file for an EIN number with the government. We need to know that. And we need the paperwork, the actual paper, the SS4, I think, that the government sends you when that is issued. Inspection is something that's going to happen each time you want a new draw. So you have to pay, I think it's anywhere from $150 to $300 per inspection. That's for somebody to come out and say, yes, he said the drywall is up, it's up, and then they'll do the next disbursement. A survey, some of the lenders actually require a survey. That means they go out and inspect they survey the land area and verify that that is accurate. Hazard insurance is something that everybody's going to need. And usually as part of the disbursement of the loan, it's going to pay for the whole 12 months of the hazard insurance in advance. That, of course, makes sure that the lender doesn't lose out if something weird happens to the property. And last but not least, we're going to need to see the operating agreement or bylaws, depending on what type of legal entity you have. It's operating agreement if you have a C Corp, and the corporate bylaws if you have an LLC. All right, somebody's asking, do we provide bridge loans for wholesale deals? I am not sure. I don't know the answer to that, so I apologize. But if you shoot me an email at tim@financeagents.com, I'll be able to get an answer to you. Maybe you could talk to a guy who runs that program, and he'll give you a better answer. I'm sorry, I don't know the answer to that. Again, somebody asked, what are the 4 documents needed Just to go through it again, if you want to get reviewed, you need an application, you need the purchase sale agreement, you need the, golly, I'm blanking on it. I think Darren's going to pull it up. The application, the renovation budget, purchase sale agreement, and 1 year of your tax returns. Now, if somebody's asking, are there restrictions to the financing? Other than what we were talking about right now, the primary restrictions are simply no more than 90% of the purchase cost, no more than 90% of the renovation cost. They will actually look at your renovation costs to make sure that they're real. And it can't exceed 70% of the after repair value. Those are the primary restrictions. Besides that, we have the location issues if it's overly rural. There might be some issues with different property types. Today I'm really only talking about residential fix and flip. We do handle commercial fix and flip. We'll do another show where we talk about it. But the commercial isn't going to work with the 100% stuff that I'm going to talk about next. So today we're just focusing on the residential. If you have specific restrictions, feel free to put them in. Other than that, I think it's basically what I just said. All right, now a reminder, before I get into how anybody can get most anybody, how a lot of people can get 100% financing to cover that gap, right? You talk about 90-90. You want to get that 10%. You wonder where that 10% is going to come from. Or maybe you have it, you just don't want to come out of pocket because you want to do 2 properties instead of 1. I'm going to get to that in a second. Just a reminder, come on next week. Next Wednesday, we're going to be talking about fraudulent funding services. The last thing you want to do is get ripped off by some international fraudster or sign up for something that sounds great and ends you up in jail. Come back next week and we will talk about that. All right, so last but not least, I'm going to be talking about how to get 100% financing for residential fix and flip. And we're going to give an example here. It's our 2-hand example. That's what the picture that Darren's about to put up on the screen. I'm stealing this from Frank Alejo, a long-term member office of ours, so I'm giving him credit for the analogy, but it's pretty simple, right? And it comes down to this. In your left hand is where we're going to put your fix and flip financing. And you may be thinking, that hand's empty. I don't have the 10% that I need for the acquisition and the renovation costs, which, by the way, you have to show you have in advance, you remember, plus the 3 months of debt servicing. You got to have that all in advance. So what we do is, instead of trying to get one lender that's going to go super hyper aggressive and give you 100% financing, what we do is we go to some of the other funding programs that we have. Now, if you're familiar with finance agents, you will know that we have a lot of different funding programs, some of them based just on your personal credit, right? You don't have to have experience, you don't have to have other assets, just to have good personal credit, and there you can get money in order to finance a purchase. So let's say you need $20,000. You're looking at a property where it's, let's make the math simple. You need a $100,000 acquisition and you have $100,000 renovation costs. It's pretty high reno cost, but whatever. So you need $10,000 for the acquisition, $10,000 for the reno, and a few months debt servicing. You need 20 grand cash in your hand in order to proceed. Where do you get that cash? Well, first of all, if you have a 700 or better FICO, then we can go out and get business credit cards. They don't even show up on your personal credit, and you can pull cash out of those, and there is the money in order to finance your upfront payment. All right, so that is good. A lot of those even come with 0% intro promos. So heck, you're actually getting the money at 0% interest. If you flip that thing in 3 to 6 months, you might be able to ride that whole thing without paying any interest on that money. So that is excellent. And once the cards are open, you can use it over and over and over again for the life of your business, up to 30 years. It's an excellent way to pair those two programs together. So you got to have 700 or better FICO for that. Now, here's something even better than that. Let's say that you're working somewhere and you're doing your flips on the side. So you have W-2 documentable income with pay stubs. Now, not just the credit cards. We could still get you the credit cards. We can also get you low interest, long-term personal loans. So imagine getting a 7-year loan at, say, 7% interest. The payments are going to be really low. Between that and the credit cards, we might be able to put 200 grand in your hands for you to now go from doing 1 fix and flip every 3 months to doing 2 or 3 a month. It has a big impact on the number of opportunities you can get. And right now, while the market's good, this is when you want to be hitting those fix and flips, right? How many can you fix and flip as fast as possible? That's the way to get paid and really could put a lot of money together and have a great year. So that is the best way to get 100% financing on all of your fix and flips. And again, it's available if you have a 700 or better FICO, and even more if you have W-2 documentable income. Somebody else is asking, are there monthly payments or balloon payments on the loan? All right, so let's talk about that in two parts. For the fix and flip financing, you're going to have a monthly loan payment. That's why I said you have to have 3 months interest reserve set aside. So you should always expect you're going to have monthly payments on the financing. And for the credit card or personal loans, of course, you can have payments on whatever you use. The nice thing about the credit cards is you pull the money out while you're using it, you're making payments, but once you pay it off, you have no payment until you use it again. So if you think, hey, I'm going to do some flips now, but I want to take the winter off because I'm going to Europe with all the money I made, then great. You don't have to make debt payments on that while you're out of the country. All right, next is, what is the maximum loan amount we can offer? Great question. You may have noticed early on I said the loans range from 100 grand to 5 million. So that is the range, but I'm not seeing a lot in the 5 million range. And when we're talking just about residential properties, heck, you're just not going to see properties like that too much that are worth that much money. That's just a lot. So we're seeing a lot of deals in the $200,000 to $500,000 range. We have some larger deals we're working on, but that's where we see most of them coming in. As far as the credit cards and the personal term loans, it's relatively easy to get, say, $50,000 to $100,000 in credit cards, which are great for financing rehab costs, by the way. And the personal term loans, it's going to depend on your credit and your income, but we just had somebody get 200 grand in personal term loans in a couple weeks. So between those two programs, you might be able to get an extra $300,000. I think we have a client right now who's on track to get about $360,000. So you can get a lot of extra money that you can use to really bolster the other products. All right, it doesn't look like we have any more questions, so I'm going to go ahead and wrap it up for the day. Thank you, everybody, for coming on to the show. Make sure to come back next week to find out about the things you want to look out for and be afraid of. In the interim, thank you for coming on, and we look forward to doing a lot more flips together.